Not Offshore Partners focuses on the shuttle tanker segment. Shuttle tankers are substituting pipelines in deep sea oil production. We have a young fleet, and for the third quarter of 2016, we reported our best ever financial results. These are our highest ever revenues and operating income, together with our highest ever adjusted EBITDA and distributable cash flow. The fourth quarter results will be released on the 15th of February at our Investor Day in New York. Now turning to the presentation. Slide 3, Company Overview. At the time of the initial public offering, our fleet of 4 vessels had an average age of about 3 years. Now, over 3 years later, we have a fleet of 11 vessels, which have an average age of about 4 3/4 years. We therefore have a modern fleet of state-of-the-art shuttle tankers, and our 4 drop-down candidates from Knutsen NYK give us visible growth. The annual distribution is currently $2.08 per unit, a distribution of 9.4% with a unit price of around $22. Despite market volatility, every year vessels have been added to the MLP, demonstrating our sponsors' strong support of and commitment to it. To date, our fleet has grown by 275% since the IPO in April 2013. Investment highlights, slide 4. Shuttle tankers are a niche market where new capacity is based on long-term contracts. Our sector is unique amongst marine MLPs in that there has been no speculative ordering of tankers, so that the partnership should yield stable and sustainable revenues. Before a new contract or vessel, our sponsor Knutsen NYK will always agree long-term employment for the vessel with the charterer. We are a pure play shuttle tanker business, and the MLP fleet is modern and has an average age of around 4 3/4 years. These vessels are employed on long-term contracts with international energy majors, and the average residual duration of these contracts is around 5 years. This solid contract base translates into a revenue stream with a backlog of $837 million. NOP trades at a significant yield premium to the Alerian index, which represents around 75% of MLPs by market cap. Unlike most of these MLPs, however, we are operating in a space seeing substantial oil production growth, and consequently the supply of shuttle tankers is tightening as this demand grows. The sponsor, in conjunction with NOP, brings operational and technical expertise, strength and stability through experience, scale and market presence. The shuttle tanker's integrated nature in the offshore supply chain creates a low threat of substitution. There are high requirements by both customers and regulators, creating a preference for well-established operators, given the technical and managerial expertise required and the cost/impact of any downtime associated with non-use. At the end of September, we had our best available liquidity position to date, with cash and cash equivalents of $27.4 million, with an undrawn credit facility of $35 million. The credit facility is available until June 2019, and we have good access to debt capital markets through strong banking relationships. Currently, 62% of our debt is on fixed interest rates. There are no CapEx commitments because of the way we structure our MLP, and there are no debt maturities until June 2018. Slide 5, Private Preferred Convertible Equity, our key terms. Back in December, we lifted any market perceptions about an equity overhang in the MLP through the issuance of $50 million worth in the Private Preferred Convertible Equity. The principal terms were for an amount of $50 million with an 8% fixed coupon payable quarterly. With this coupon of 8% and a conversion of 24, it gives an implied yield of 8.67 based on the current distribution. In addition to an attractive coupon and strike price, issuing costs for the private preferred convertible equity are significantly less than those of common equity, as evidenced from recent transactions. Typically in today's market, all-in costs of common unit to raise can comfortably in double digits, taking into account both market discount, investment banking fees and professional fees. The private preferred convertible equity has no preemptive rights, which are quite common in such agreements to the detriment of the issuer. And although the private preferred convertible equity makes our balance sheet a bit more complex, previously only having common units and bank loans, it is on agreed terms and conditions which management felt very attractive. Today, therefore, in the current equity markets, NOP has been creative in finding other sources of capital at accretive terms and conditions. Subsequent to this issuance, we saw a very positive market reaction and significant improvement in the unit price. As an opportunity, therefore, in January, we decided, with the unit price over $20, that we would execute a block deal for 2.5 million common units. We launched the deal. The official closing price was around $24.2 per unit, and the block was offered to the public at $22.45. The MLP received net $22.08. As with all block trades, this discount was calculated from the agreed closing price. Slide 6. Stable operational performance results in stable financial performance. Since the formation of NOP, we have had very strong levels of vessel utilization, which means high and increasing predictable revenue, adjusted EBITDA, and discounted cash flow, as more vessels are added to the fleet. In Q3, we had record distributable cash of $20.3 million, and we made a $15 million distribution. This translates to 52 cents per unit. The next distribution on the 15th of February will be at the same level. The distribution coverage ratio for the third quarter was 1.35. Since our initial public offering over 3 years ago, we have declared distributions of, in total, $7.18. So for our initial investors, this is a total return of over 34%. Our current distributions are around 9.4%. Slide 7, the RACL drop-down. On the 1st of December, we were pleased to announce the latest addition to the MLP fleet, the RACL Knutsen, for an acquisition price of $116.5 million. As well as being an accretive investment, this vessel has remained time charter duration of over 8.5 quarter years, plus 5 further years of options. So it significantly increased both our charter backlog and reduces the age of the fleet. Built in by COSCO in China, it was delivered in 7th of March 2015. The RACL Knutsen is a Suezmax class shuttle tanker, which means it carries 1 million barrels of oil. It operates under a time charter that will expire in the first quarter of 2025. The net charter rate would yield around $6 million in net income, and approximately $13 million EBITDA for the year ended 2017. Slide 8. Long-term contracts backed by leading energy majors. The Windsor Knutsen has been on a 2-year contract from the 13th of October 2015 with Brazil Shipping, a subsidiary of Royal Dutch Shell. It has options to extend for a further 6 years. Hildred Knutsen and sister Toril Knutsen are employed on the Goliath field on original 5-year contracts on the 2 vessels, with an average about 2 years remaining. Given the specialized nature of this contract, we would expect these vessels to operate on this field throughout its life. The Bodil Knutsen is our largest shuttle tanker, operating in the North Sea as ice class and on charter to Statoil until May 2019. There are 5 further years of extension options. Statoil has recently been given permission to proceed with the development of the Johan Castberg oil field in the Barents Sea in the Arctic Circle north of Hammerfest. This should provide medium-term employment and security for the Bodil. 4 of our vessels are on long-term bareboat charter until 2023 to Petrobras. These vessels are amongst the youngest in the Petrobras fleet, delivered between 2011 and 2012, and are utilized. Dan Sabia and Dan Cisne are unique size, and Fortaleza and Recife have shallow drafts and lots of thruster capacity. 3 of these vessels have already undertaken their first 5-year special survey at the charterer's expense. Delivered in 2013, the Carmen Knutsen is on charter to Repsol Sinopec until 2023. The Ingrid Knutsen was delivered in December 2013 and is operating on the North Sea for Standard Marine Tonsberg, a Norwegian subsidiary of ExxonMobil. This will expire in the first quarter of 2024. The charter has further options to extend for 5 years. Slide 9. The drop-down inventory for potential acquisitions. Today we have 4 further potential acquisition drop-downs to be added to the 7 vessels to the fleet. The fixed contract periods for the drop-down fleet is a minimum of 5 years. Slide 10. Shuttle tanker market overview. Slide 11. A critical component of the offshore operator infrastructure. Shuttle tankers are substituting pipelines in deep-sea oil production. The forthcoming offshore developments are deep-sea oil fields and where traditional MLP pipeline investments are not an option. For example, the pre-salt layer of oil in Brazil is 130 kilometers offshore in ocean depths of over 1,500 meters. So pipelines cannot be built economically. The shuttle tanker, therefore, can be thought of as a midstream mobile pipeline, bringing the oil production to shore and generating fully contracted, stable, non-volume-based revenue streams. It is also a more economic alternative in most cases. With significantly lower initial investment costs, the tanker brings destination flexibility, being able to discharge at multiple ports. It is unaffected by both water depth or seabed terrain. The vessel can be moved between fields, so field size or life are no longer as much of a consideration. Our customers charter these shuttle tankers, which have state-of-the-art dynamic positioning. This is a computer-controlled system which automatically maintains a vessel's position and heading by using its own propellers and thrusters. For the DP2 system installed in all our vessels, we have a much higher degree of redundancy, and it allows the vessel to remain in position in open seas despite harsh conditions. The shuttle tanker is field-specific as it is built to individual requirements of the major, and it is an integral part of the energy major's logistics supply chain for extracted crude, transporting the oil from the offshore production to shoreside. The specifically designed tankers have sophisticated bow and submerged turret loading equipment, as well as advanced dynamic positioning, systems costing around 50% more than a conventional tanker. In operations, there are stricter standards and more specialized crewing requirements when compared to conventional tankers. Consequently, tender-based business drives construction of new building decisions, and long-term contracts are normal in this market. The niche market where new capacity is based on long-term contracts, slide 12. We are a market-leading shuttle tanker operator with many years of experience in these offshore loading and dynamic position operations. Mr. Seglin, who is the current chairman of NOP and part owner, has been working with offshore shuttle tanker development since his time with an energy major in the 1970s. Mr. Seglin joined Knutsen in the early 1980s, and the company won a contract for 2 shuttle tankers in December 1984. Since then, Knutsen has grown organically for over 30 years as the business has been built into a sizable fleet of these tankers. Currently, there are 30, including orders. Our sponsor, Knutsen NYK, according to Clarkson Platou Research, is part of the largest shipping group in the world. And NYK, founded in 1885, is a major company in the Mitsubishi family. NYK Knutsen is the exclusive vehicle for investment in shuttle tankers by the sponsor. Slide 13, Knutsen NYK. In the last 12 months to the end of October 16, both Knutsen NYK, which manages the shuttle tankers fleet of NOP, and Knutsen OAS Shipping, which manages Knutsen Group's LNGs and product tankers, have not registered any lost time injuries, and during that period, more than 7 million hours have been worked all over the world. Slide 14, one of the world's youngest fleets with the latest technology. The current drop-down inventory will allow the NOP fleet to continue to maintain a young age profile. All our vessels are equipped with dynamic positioning, and 3 vessels are winterized for Arctic conditions in the Barents Sea, a large potential growth area. Bodil Knutsen, Hilda Knutsen, and Toril Knutsen. Slide 15. Oil production from shuttle tanker operated fields. North Sea. In the projection shown, there are a 9% depletion rate applied to existing fields. This, we believe, is conservative, as the average depletion between 2000 and 2014 has been only 6%. All 10 fields that are shown as developments will add 0.5 million barrels of output from 2016 to 17 and are moving forward according to schedule. The Johan Castberg field in the Barents Sea will be developed using an FPSO and shuttle tankers. Recent drilling in the Barents Sea has added significantly to the reserves and prospects for development. In the latest licensing round in Norway, new acreage was opened up with great success. The Barents Sea will become the new shuttle tanker frontier for Europe in the 2020s. Brazil. Our main sphere of expansion in Brazil is our 4 drop-down candidates that will all operate there. A 9% depletion rate for existing fields is an official Petrobras figure, and despite the corruption scandal undoubtedly delaying production, growth is impressive with all sanctioned projects moving forward. In addition, the post-2020 Libra development, which will be 12 to 16 shuttle tanker demand, is moving forward according to plan, unaffected by the impact of the corruption scandal. The positive news from Brazil, slide 16. Last year, Petrobras sold a 66% stake in the 1 billion barrel Carcara field to Statoil, making the Norwegian major the first international oil company to acquire ownership and operation of Brazil's one field in Brazil's giant pre-salt. Petrobras routinely report monthly production figures, and in their November press release, their operations reached a new daily production record in the pre-salt by producing 1.23 million barrels per day on October the 11th. 2 years previously, the figure was around 500,000 barrels. All this oil has to be transported by shuttle tankers, as the fields are 130 kilometers offshore and over 1,500 meters deep below sea level, so a fixed pipeline is not an option. Petrobras have drilled wells in the pre-salt in increasingly less time. The average time to build an offshore well in the Santos Basin pre-salt cluster used to be 310 days until 2010. Subsequently, progress made in knowledge about the geology there and the introduction of advanced technology with increasing project efficiency. In 2015, their time had dropped to 128 days, and in the first 5 months of 2016, the average time to build a well had reached 89 days, a reduction of 71% between 2010 and 2016. According to Petrobras, the average cost of extraction of oil from the pre-salt wells totaled less than $8 per barrel of oil equivalent and has been gradually decreasing. Slide 17, tenders have returned. With strong sponsor support and despite recent market volatility, we continue to grow. The market for new build contracts is returning, and we have recently had several tentative inquiries and a firm invitation to tender for 2 new build shuttle tankers. Fernley's shipbrokers see a significant demand for new shuttle tankers going forward and expect tenders for in excess of 40 vessels up to 2020. This figure includes attrition demand, which is about half the total. Have we delivered on our expectation? Well, the fleet has grown 175% since the IPO. Our drop-down inventory is still 4 vessels, representing a growth potential over and above the initial fleet of 275%. In addition to securing 7 new drop-down vessels since IPO, we have also entered into new contracts for Windsor, Extended the Bottle, and Carmen contracts. The MLP units have seen a 39% distribution growth since the IPO. Slide 19, summary. In summary, the last reported third quarter was another strong operational performance with minimal off-hire, as was 100% utilization in this quarter and 99.7% since the IPO, excluding the scheduled dry dockings. We have a solid and highly profitable contract base with a revenue backlog of $837 million on an average contract duration as at the 31st of December of around 5 years. We have a modern shuttle tanker fleet with an average age of 4.7. Contrast this with an industry average of about 11.5 years. The partnership is well placed and highly focused on expanding in the medium term as the oil markets recover. And no one has more experience in operating these sophisticated shuttle tankers than Knutsen Offshore, and we operate these tankers with real expertise. We have a supportive sponsor who has a large asset base with which to grow the MLP by capturing a good proportion of the expanding market. Thank you for your time and your interest in the company, and I'm ready for the Q&A section.
So we now have on the line with us John Costain, CEO of Knot Offshore Partners. Ticker symbol is KNOP on the NYSE. We'll jump right into the questions. John, can you talk us a little bit about who your customers are, and do you expect to add any new oil and gas companies to your charters this year?
Yes, we have mainly energy majors and national oil companies. The main customers are Statoil, Petrobras, ExxonMobil, Petrogalp. We expect to continue to contract with these companies. We don't tend to have intermediary counterparties, so basically we're just contracting with end users of national oil companies, really, mainly based in the pre-salt Brazilian area and the North Sea and the Barents Sea, where there's a need for shuttle tankers and the market is significantly expanding.
Thank you, John. And next, can you talk a little bit about, is there any seasonality at all to your business? Mm-hmm. And also, are you affected at all by commodity prices?
No, on both those counts, pretty much no. Obviously, if the weather's bad, it takes a bit longer to load the oil and discharge, but generally that's why you have a shuttle tanker, because there's a lot of redundancy on it, and it can load and discharge oil in quite heavy speeds. There isn't really a lot of seasonality, therefore. The oil is basically produced all the year round, this is a mobile pipeline business, effectively taking the oil from a floating storage to shore side. The oil is continually produced, and therefore it's a continual demand for the shuttle tankers. The shuttle tankers, there's a small amount of redundancy. That's basically what I mean is we have a little bit of an allowance for loading and discharging. There isn't a full 99% utilization like there is in the bulk ships, because obviously it's a critical component that it needs to be available at all times. So generally, no, there isn't any variation. These are non-volume-based contracts. They're what they call time charter contracts. So irrespective of how much oil you're lifting and how you heavily utilize the tanker, as you get paid a fixed fee per day for hiring the vessel out.
Thank you, John. Next, can you talk a little bit about your distribution plans in 2017? Can investors expect to see some growth in distributions moving forward?
We probably will not increase the distributions at this present moment in time, but generally we aim to increase the distributions around equity raises. So we obviously realise that over time the distribution will have to increase. Today we've just raised $105 million on the US capital markets, and generally we're trading at an elevated yield, about 9.5%, 9.25%. The Illyrian's about 7%, so we'll keep an eye on the Illyrian yield and also how the market is expanding in the shuttle space and how much equity we have to raise before deciding on a distribution policy. But I don't envisage a distribution increase as at today, as I think we're better placed in trying to deleverage the business a bit and using surplus cash flows to that effect. We don't see any potential advantage in increasing the distribution over 10% yield. So we're quite comfortable with we pay $2.08 at the moment on a unit which is trading at about $22, $23. If it was going up to $27, $28, perhaps we'd think about increasing distribution, or alternatively, if we were raising more common units on the US stock market, we'd have to consider increasing the distribution as well, and that's generally the policy that for us.
Thank you, John. And our next question, given the proceeds of the preferred placement and the recent secondary, it's likely you have some capital to do at least one and potentially more than one drop down from. And how many would you anticipate doing and on what terms? And this investor then asks. They presume that the terms will be similar to your recent drop down from your sponsor, but if not, what changes do you think you'd anticipate happening?
No, I don't see much change. I think they'll be very similar. We have 4 vessels in the pipe, all delivering for 6 months of this year. Some of those will be dropped in. There's no hurry. The sponsor has available finance, and the vessels are fully financed with the sponsor, and they're on long contracts. So we just take opportunities to equity raises as the market opens up, and we have enough capital now to drop a further 2 ships in, I would guess. Obviously, I can't say when exactly we'll do it, but because we're still waiting for approval from the charters on the first ship, and the second ship delivering fairly soon as well. So we have plenty of uses for those cash. We can call the vessels from the sponsor once the proceeds are received from their preference issue. So at the moment we've used the proceeds to tidy the balance sheet up, really.
Yes, no, very good. We have just about a little over a minute left. I guess just in kind of a summary, what's the key takeaway investors should have about the Not Offshore story?
Well, Not Offshore today is well positioned. It has organically grown over 30-odd years to being I would say, the most substantial shuttle tanker operator. The shuttle tanker space is significantly expanding. The Brazilian pre-salt today, again in December, Petrobras broke new records. If you look at it 6 years ago, there was no production in Brazil hardly on the pre-salt. Today, the average production is about 1.3 million barrels a day of oil. So we've seen massive growth in Brazil. And the next 4 shuttle tankers which are available to this MLP are all based in Brazil. So we are expanding our operations heavily there. And therefore, I feel that we're as a shuttle tanker operator, with all the experience we have more experience than anyone in this field. We are very well positioned to win a lot of the contracts. Fernley's estimate that there's a need for about 40 shuttle tankers by 2020, whether that materializes or not, that they will be required longer term. So even we expect the contracting and tendering to open up for the next 2 or 3 years, and a significant expansion in this space. And therefore, the growth prospects for this business are very, very exciting.
Thank you, John. Thank you for that. For our viewers, we were just talking with John Costain, CEO of Not Offshore. Ticker symbol again is KNOP. Trades on the New York Stock Exchange. You can sign up for news alerts on Not Offshore right here at RedChip.com, and you can keep abreast of the developments as they continue to see some success moving forward.